So today we're going to continue with Chapter 9 on fixed assets for financial accounting. And on Tuesday, we went over all these depreciation methods, straight line, units of activity, double declining balance, and all the calculations involved with that. And we're just going to do a quick problem to get us back into things. The company bought a refrigerator for their wholesale warehouse at a cost of $85,000 and an estimated residual value of $4,200 with a useful life of 8 years. What's the annual depreciation computed under the straight line method? And so we'll take 85,000. And to get the straight line rate, we'd take 1 divided by 8, which is 12.5% per year, I think. And multiply 12.5% times 85,000, and we get perfect. Should be, oh, yep, perfect. Yeah, we have to subtract the residual value first. So that we get the total amortized, the depreciable base is 80,800, and then we divide by 8 or 12.5%. Perfect. So now we're going to go into some of the disposal of fixed assets, which is when fixed assets aren't useful anymore, the business needs change, they have to discard them, sell them, trade them in, and the fixed asset has to be removed from the account. So we have to remove the historical cost, remove the accumulated depreciation, and record any gain or loss on the transaction. And to completely remove an asset when discarding an asset, especially a fully depreciated asset, see a historical cost of 25,000 and it's been fully depreciated at 25,000, we'd remove it from the books by debiting the accumulated depreciation, crediting the equipment, reducing them both to 0, and that removes it from our listing, removes it from our books. And there's no impact to the income statement because it's off the books now. But if we're displaying our historical cost and our accumulated depreciation on the balance sheet, it would just reduce both by the same amount. And so for presentation purposes, it's important to remove equipment that's truly been discarded. And that's a common thing at the end of the year, just looking at the fixed asset listing and saying, why is this fully depreciated office chair from 1984 still on the books, right? So sometimes there's just some cleanup that needs to happen. But if it is still in use, then it can still be fully depreciated and still in use. That's perfectly acceptable. And if an asset has not been fully depreciated, if the asset has not been fully depreciated, depreciation needs to be recorded up until the date that it is discarded or traded in or sold. And assume that equipment costing $6,000 with no residual value is depreciated, straight line rate of 10% or 10 years. And the depreciation balance after adjusting entries on December 31st is $4,650. On March 24th of the following year, the asset is removed from service and discarded. And the initial cost was $6,000. So we have to credit equipment for $6,000. But first we have to record the depreciation so far during the year. And so to get the full year, we're depreciating $600 a year because $600 is 10% of $6,000. But the asset is removed on March 24th. Since it's in the last half of March, we're assuming that it was depreciated for January, February, and March for the whole month. So that's 25% of the year, or 3 out of 12 months. And 25% of 600 is 150. So we record depreciation expense as a debit and then a credit to accumulated depreciation to record it first. And then we remove the new amount from the book. So we used to have 4,650 of accumulated depreciation. Now it's increased to 4,800 is our debit to accumulated depreciation. Our credit to equipment is 6,000. And so on the date of the sale, the net book value of the equipment is $1,200 because the 6,000 minus 4,800 is 1,200. And since we're writing it off, we don't have, and discarding it, we didn't get any cash for the asset. So we need to record a loss on disposal of equipment of $1,200. And you can think of it as, okay, what was the net book value? What was the consideration that we got for it? Or you can think, we just need to balance our journal entry. Our debits must equal our credits, and we're crediting equipment for 6,000. We only have 4,800 of accumulated depreciation. We need to add this 1,200 in loss to balance our journal entry. And if we're selling the asset, it's the same process. We need to record the depreciation. We need to take the accumulated depreciation and the historical cost off of our books. And then the only difference is that there's cash is also included in the sale. And then there's also a gain or loss if the debits don't equal our credits, if we're selling it for less than or more than its value. So selling the asset, we have a $10,000 historical cost asset, straight line 10%, selling it for cash on October 12th. Since this is the first half of October, we're assuming it was sold the end of September. So we're depreciating 9 months of the year. $10,000 times 9/12 times 10% is $750. And so we have to record that as our depreciation expense as of October 12th. And then the beginning balance was 7,000 on accumulated depreciation. So when we sell the asset for $2,250, that is equal to the net book value on October 12th. And so we debit to cash because we're receiving cash, debit accumulated depreciation, and credit to equipment. And if we sold it for 1,000, we would have to record a loss as a debit for $1,250 because we're short that amount on our debits. They both need to equal 10,000. And also, that's the difference between the cash received and the net book value. And if instead we had to record a gain, the cash received was 2,800, and so our total debits are 10,550, and so our credits also have to equal 10,550. And the gain increases owner's equity, so it has to be a credit. And just remember that our debits are always displayed on top and then credits indented on the bottom. So we couldn't, on the homework, just make sure to, if it's a loss, like in the previous example here, make sure to record the loss grouped with the debits as opposed to with like underneath equipment, for example. So Consumer Gas purchases a delivery truck for $48,000. The truck has an estimated life of 6 years, residual value of $6,000. The company uses the straight line method of depreciation. Why don't we work through this problem here? on what is the gain or loss going to be on the sale. So after the depreciation's been updated for the year, at the end of year 4, the depreciation at the end of the year is 28,000. Um, so at the end of the year 4, the truck is sold for 16,000. What is the net result of the transaction for the company? So we have 48,000 minus the minus 28,000 of depreciation. We have $20,000 net book value of the asset, and if we sell it for only 16,000, then we have a loss of $4,000 on the asset. And so that would have to be recorded as a debit in our journal entry. And so equipment acquired on January 8th has a net cost of $212,000 and an estimated useful life of 15 years with a residual value of 14 using the straight line method. What was the book value of equipment at the end of the 5th year? So first, and then assuming it was sold April 1st of the following year, what would be the journal entry for the equipment? So we're going to move a little quickly because we do have a lot of slides today. The initial cost of the equipment was $212,000, and at 5 years, the depreciation each year was $13,200 because that is 1 divided by 15 is I'm not sure what percentage that is, but if we take 212 minus 14,000 divided by 15, we get our annual rate of 13,200. It was purchased in the first half of January, so we're depreciating a full year in the first year, so we don't have to worry about partial year. And then we have 66,000 in depreciation, so our net book value is 146,000 at the beginning of the year. We depreciate 3 out of 12 months because we're selling it first half of April. And then that's an additional 3,300 in depreciation expense. We get cash of 105,800. Accumulated depreciation that we already have is 66,000 plus 3,300 is the 69,300. And then our debit to equipment was 212,000, our historical cost. And so then the difference between our debits and credits to balance, we have a loss of 36,900. And so equipment acquired on January 6th, cost of 425,000 has a 20-year useful life, residual value of 35,000. And then we're selling it January 3rd of year 4 for $360,000 and recording the journal entry if it was 3,600 or if 360,000 or 370,000. So each in the first 3 years, we have 425,000 minus 35,000 to get our depreciable base, divide by 20 years, 19,500 each year. Then we have our net book value of 366,500 because we had 58,000 in accumulated depreciation. We're selling it at the beginning of the year. And if we only sell it for 360,000, then that's 6,500 less than the net book value. So we're recording a loss. And then if we sold it for 370,000, we'd have to record a gain of 3,500. So depends on what was received for the transaction, whether it's a gain or loss, and then how we record that. I will go into natural resources. So companies, timber companies, oil mining companies, especially in companies that extract natural resources from the ground, timber, oil, mining, we have to record the cost to acquire the natural resources in the land. So there's land, but then there's the stuff that's actually in the land and the mineral rights and the oil mining rights. They're naturally occurring assets, and then we're removing them for sale, like harvesting timber and minerals, and then also removed and sold over 1 year, which makes it a long-lived asset that we need to record. And it's called depletion expense when we're reducing or mining away the oil or timber in the land. And we calculate what's called a depletion rate by creating an estimate of the total amount of resources in the ground. So oil companies use oil field units or estimated barrels of oil that they are in their field. Timber would use an estimate of the amount of timber or trees or lumber in a forest, and mining companies, up in Hibbing, they estimate the amount of taconite that's in the ground, right? So you have to take the total cost of the resource that costs to obtain the mineral rights, essentially, and any other costs associated with getting those rights, and then divide it by the total amount of units, for example, barrels of oil. And then we get our rate per barrel of oil, and then that's our expense taken throughout the year for depletion expense, is the depletion rate times the quantity removed. For example, if we have a cost of obtaining a mineral deposit was $400,000, and then the estimated total units in this deposit, we get a geologist survey, they estimate what's there. It's 1 million tons. And then this year we mined 90,000 tons. We have to compute our rate. So we take the 400,000 divided by 1 million, and we get 40 cents per ton is our cost. And then our depletion expense is $36,000 for the year, because we take 40 cents per ton times the 90,000 that was mined. And then we record that as an adjusting entry, depletion expense and accumulated depletion. So yeah, there is some homework and quiz questions on depletion. They're related to timber deposits, and essentially we just take the total that's available, compute our depletion rate, and then multiply out to get the cost that we allocate. And I guess just a general comment, this is an estimate, and the estimate's revised every year. Every time there's a new geologist survey that determines there's a new number of tons available, or if we're putting additional costs into it, we're adjusting our estimate similar to how we're adjusting useful lives and salvage values for fixed assets and equipment. We adjust our depletion estimates as well every year. But it's only going forward. We don't go back into the past to adjust. It's our best estimate of allocating the cost. So for example, if next year a new report comes out and we think there's only 500,000 tons, in total, we would take 500,000 tons minus 90,000, or if they estimated 500,000 remaining, we'd take the 500,000 remaining tons, divide by the remaining cost, and then that would be our new rate, right, next year. So next year our base would be 400,000 minus the 36,000, and then we divide by, or we, yeah, divide by the new 500,000 estimate. That would be how we'd adjust that rate. So depletion refers to the harvesting of natural resources. Which of the following would more likely be subject to depreciation than depletion? C, exactly. And that's because the trees in an apple orchard usually are not naturally occurring. Where really people invest in creating apple trees. The University of Minnesota developed the Honeycrisp apple like 10, 15 years ago. And that was a huge thing. And then companies would like invest, like they'd buy the seeds and then they'd plant the stuff. It's not naturally occurring. You're not, companies not purchasing mineral rights for the timber from the Department of from the Bureau of Land Management. It's intentionally planting a tree and then you depreciate the trees as opposed to purchasing timber rights from the government and then logging away that timber at a rate over time. Intangible assets are another class of long-term assets, and we need to amortize their cost over time. This is such things like patents, trademarks, goodwill, and they're intangible because they're not like, you can't touch the trees or the truck. It's a patent. It's something on paper. It's a right to something, usually legally, right? And we can't touch them, but they are real assets to our business that are going to provide some future value. And the major challenges with them are determining the initial cost and determining the amount of amortization or whether they should be amortized at all. For example, goodwill doesn't have a useful life. It's created when a company like acquires another business for more than the sum of its assets. Because businesses are more than the sum of their parts. I mean, think about Coca-Cola. If you added up the value of all the factories, all the cash that they have, that would not even come close to the value of Coca-Cola as a business. But if Pepsi bought Coca-Cola, they would have to record goodwill as the difference between, and then that really accounts for the brand value. And that's not amortized every year because that doesn't get like used up and go away, but it is tested for what's called impairment. And we'll go over that on future slides. But basically, intangible assets are either amortized or they're tested for impairment annually. And if they're impaired, it's basically like, did Coca-Cola have some major thing that decreased the value of the brand and they're not going to make any money in the future? So. And amortization results from the passage of time or a decline in the usefulness of the intangible asset. And the passage of time is especially relevant to things like patents. They're only available for 20 years. So a drug company develops a patent and R&D on a drug company is considered very speculative in nature. And so we expense that every year as research and development expense. But then the cost, so that's expensed every year. The cost that's actually capitalized is it's the legal fees that are created. If a company's creating the patent themselves, the cost that's recorded on the books and capitalized to be amortized in future years, it's only the legal fees and any costs to legally create the patent because the research and development was expensed as we go. However, if another company is purchasing the patent, that's a lot simpler. The historical cost of the patent that's already created, it's a lot more certain. We just capitalize the entire cost that was given to purchase the patent. And patents are from manufacturers or drug companies, it's new technology that's developed and the government gives exclusive rights to produce or sell goods with these unique features, and they have to give the government a list of this is the patent, this is exactly what the product does, and then it's actually public knowledge then what it is so that other people don't do that. And then that goes into, usually it's 20-year life of the patent. And it can be purchased from others or you can develop internally. And the patent is that, well, then the cost is written off or amortized over the expected useful life, which may be less than its legal life. If we have this fancy new drug that we have the patent for 20 years, but we're expecting technology to develop in such a way where some other drug that's different and doesn't infringe on our patent but treats the same symptoms is going to come out in 10 years, the useful life of our patent is likely only 10 years. And it's less than the 20-year legal life, but if our technology is going to be obsolete in 10 years, we have to estimate that, we need to allocate it over that period of time and not the full legal life, because that's when we're going to make the revenue. And amortization expense is recorded by debiting amortization expense and then crediting patents directly. We don't have accumulated amortization. We just reduce it directly. And so in this method, we say we acquired the patent right for $100,000 at the beginning of the fiscal year. So the entry to create the patent would be a debit to patent and a credit to cash because they just purchased it outright. And then at the end of the first year, we're estimating a 5-year useful life, so we would reduce it by 20,000, just straight line depreciation. And if it's another method, it would specify the method, but it says straight line. And a contra account is usually not used for intangible assets. And some companies develop their own patents through research and development. In this case, research and development is recorded as a current operating expense in the period that it's incurred, and only the legal fees used to register the patent are debited to patents and then amortized later. Another type of intangible asset is copyrights and trademarks. For example, Taylor Swift purchasing her masters back. Their copyrights are issued by the federal government and generally extend for 70 years or even beyond the author's death. And they include all like the rights to create, produce, and distribute the music, get the profits from it. And then trademarks are name terms or symbols for identifying a business, like the McDonald's golden arches. That would be a trademark of McDonald's. And those are created by registering them for 10 years, and then they have to re-register every 10 years because trademarks are only recognized by the government when they're recognized by the consumers. Once the brand is built in a particular area or globally, in the case of McDonald's, the government then recognizes that consumers know the golden arches means McDonald's. And then every 10 years they re-register just to make sure that that brand is still intact. If it's not intact, then they might lose it to another brand that's using that.
Isn't it like you can only have a copyright for so long, like eventually you legally cannot copyright something continuously? Because that's kind of what happened with I think the original Mickey Mouse character.
Yeah.
Ended up they kept it for almost 100 years, and then finally it was free to market.
Yeah. Yeah, and that's a lot of the case too with old music and things like that too. A lot of times, and it's, with patents, I'm not super familiar with exact patent and copyright law. But I think a lot of times it's something like 70 years or like a book, classic books. If you go to a store and you can buy classic novels, I stopped reading a long time ago, but um, you can buy them for really cheap because the only, like the Bible, no one has the copyright on the Bible. It's the cost to buy a Bible is really just how much it costs to print a Bible, and then there's no copyright that's created. And as older books like that were created, especially in the early 1900s, you can buy them pretty cheap. But for depreciation purposes, Taylor Swift's business, I don't think she's depreciating it over or amortizing. I don't think she's amortizing her masters over 70 years because are people really going to be listening to Taylor Swift 70 years from now? I mean, I will be if I'm alive, but I don't even know if I'll be alive 70 years from now, right? So I doubt they got to estimate the useful life of it to properly amortize. And they also will separate into indefinite-lived intangible assets and definite-lived. For example, this is Altria Group. They make Marlboro cigarettes, and they had a significant investment in Juul and things like that. And they had some cigarette trademarks, and they separated them between definite and indefinite-lived because some of them, a trademark can be continuously renewed. And so it's not necessarily amortized every year because there's no useful life. It's expected to be used forever, basically, until it's not. And due to essentially changing consumer preferences related to cigarettes and also just change in due to an anticipated change in the way the asset will be utilized in the future, they transferred a number of indefinite-lived to definite-lived and started amortizing them in the future. So they expected that they will only use some of these for an additional 20 years or an additional 5 years, and they started taking amortization expense on the trademark. Goodwill refers to an intangible asset of a business created from favorable factors like product quality, reputation, managerial skill. And it allows a business to generate a rate of return greater than normal. And generally, and GAAP only allows goodwill to be recorded if it is objectively determined by a transaction. And the most common way that that happens is a business acquisition. A company, for example, if we're on the Altria example, if they bought a smaller cigarette company for more than the value of its factory, then the difference between the value of the physical assets and the price that they paid objectively, there is goodwill there because they paid that price and they calculated the value of the assets. And so they would record that new assets on their book as part of the acquisition. But the difference objectively is goodwill because there is a difference there in the purchase price. And that, like, because there was a market transaction, that's evidence that it was worth something. And unlike patents and copyrights, goodwill is not amortized. However, goodwill should be recorded if the future prospects of the purchase firm become impaired. So the entry to record that would be loss from impaired goodwill, 250,000, and then impaired goodwill, and then just a credit to goodwill account itself. Because goodwill is an asset, it appears on the balance sheet and it's a debit account. And so to reduce it, we have a credit to goodwill. And an example of this happening, well, this is a little different because Altria only took a 35 or a 30% stake in Juul, so it wasn't officially recorded as goodwill. But effectively, this is how a goodwill impairment is calculated and determined. And basically, due to they listed way too many impairment factors to possibly list. In 2019, Altria had an investment in Juul, which is a vape company, and they got caught essentially marketing to high schoolers, and a lot of sanctions then from the government and reducing of the amount of flavors that they could sell, and they weren't even sure. So they invested a lot of money into Juul to get that stake, and they had to, the way they were recording it was at historical cost, basically, and not as mark to market because Juul is a private company. It's not like a stock that they can record the value going up and down all the time. And annually, you have to test that kind of investment for impairment, similar to the way you test goodwill for impairment. And they determined that because the future prospects of the business were so grim, the value had dropped significantly, and they needed to record an 8.6 billion impairment, which was much more than the value of their profits every year even. And so then they had impairment of Juul as a line specifically called out on their income statement because it was that catastrophic, really. Like their usual net income was 6 to 10 billion, and then they have an $8.5 billion charge on this investment. It was a disaster for them financially that year. I haven't kept up with them since, but I was interested in that stock at the time. Yeah, maybe don't sell vapes to high schoolers. So, just to summarize the different types of intangible assets, patents are the exclusive right to benefit. They have an estimated useful life that can't exceed the legal life of the asset. And then they have amortization expense. Copyrights have amortization expense. They also have a useful life not to exceed the legal life, but the legal life is usually so long that we have to estimate how long is this book actually going to get sold? How long is people actually going to listen to this music? And then trademarks and goodwill, they are not amortized, but we have to test them for impairment to make sure that the trademark is secure, consumers still know that that's our business. And then also goodwill, making sure that the value of our investment is not significantly impaired. And under the financial reporting of trademarks, the shape of the Coca-Cola bottle, the McDonald's Golden Arches, Colonel Sanders recipe for fried chicken, not patented, because if same as the recipe for Coca-Cola, they're not patented recipes, because if they patented them, they would have to publish them. And drug companies are constantly creating patents because then they can protect it. And then afterwards, anybody can use the recipe essentially. But for these businesses, right, they like the Kentucky Fried Chicken recipe that's kept in a vault somewhere, and they don't want to tell people, and they don't want to patent it because then 20 years from now, anybody could use the recipe. And but that is a trademark of the business, and showing them on the company's balance sheet or not really determines on were they developed internally or purchased separately. Because if they're developed internally, likely the only cost related is the legal fees to register it every 10 years as a trademark. But if KFC bought Raising Cane's and had to put a value on the trademark of the Cane's chicken recipe, that would appear on the balance sheet as a trademark, and then it would be tested for impairment. But if it's developed same with patents for drug companies, if they're developing the patents internally, a lot of the research and development, it gets expensed as you go. But then if somebody bought that patent separately, then it would be recorded as an asset, and then it would need an amortization related to it. On the income statement, amortization, depreciation, it should be reported separately or disclosed in a note, assuming that it's material. And on the balance sheet, each class of fixed assets should be disclosed either on the face of the financial statement, so like on the balance sheet itself, or in the notes to the financial statements. And the related accumulation, the accumulated depreciation also needs to be disclosed either by asset class, like land, buildings, equipment, or in total. And the fixed assets can be shown on the face, on the actual balance sheet at their book value, or and then displaying the accumulated depreciation or as the net amount directly. And then in the notes, it would say the accumulated depreciation on the assets. And if there are a lot of classes of fixed assets, they can record it as one class, property, plant, and equipment on the balance sheet, and then in the notes, it bifurcate between the rest, like all the different classes. And intangible assets are generally disclosed as intangibles or goodwill, especially if they're really large amounts. Goodwill can be a huge amount for companies that are constantly acquiring businesses, and so a lot of times that is published separately. And then there'll be a notes statement as well. So McDonald's discloses property, plant, and equipment, and then accumulated depreciation, and then net property, plant, and equipment. And then in the notes, they say, okay, this is land, buildings, and then equipment to get to the total historical cost. And it all ties out. That's super important. A huge task in auditing is looking at the financial statements and doing what's called a financial statement tie-out and making a note on every single number and making sure that everything is internally consistent. And then tying out each of the individual accounts to the books of the company. That's tying out. We have our general ledger, trial balance, and then things go from the trial balance to the financial statements, and then in the notes and in management's discussion and everything in the books and records, it all has to be internally consistent. And 10Ks can be 100 to 300 pages, and so it's a task. Apple Inc. designs iPhones. I think that's not really new information. And this is how Apple displays their fixed assets. So they have land, they have machines, they have other fixed assets, and then accumulated depreciation increases year over year, but also the historical cost increases because they keep on acquiring assets. And so if we're computing the book value of the assets in the current year, we're taking the total cost minus the accumulated depreciation. That's the book value of Apple's assets, and they increase year over year because, I mean, things are depreciating, but they're also such an expanding business that they're constantly buying new property, plant, and equipment, new capital expenditures. Generally, in good times, a company will be purchasing new assets for investments in the future. They keep on getting cash. If we think about the statement of cash flows, we have operating cash flows, investing cash flows, and financing cash flows. And if we have a lot of operating cash flows and that cash has to go somewhere, right? A lot of times that's investment in the future. So more fixed assets. And then in bad times when less investment is needed, then a company will cut back on those investments for the future until the economy comes back and revenues increase again and operating cash flows increase again. For analysis for decision making, we have our fixed asset turnover ratio this week, and that's sales divided by the average book value of the fixed assets, which is the net amount, so less accumulated depreciation amount. And it is an efficiency metric of how effectively is the company generating sales with fixed assets, and also sort of a metric of how capital intensive is the business. If we think of something like a railroad or an airline, huge equipment needs. And so the book value of the assets is going to be greater, and so the ratio is going to be less. If we go to like this slide, right, Union Pacific's is 0.4, but Manpower Group, temporary employment agency, they probably rent offices. People come in and ask for a temp job, and that's the whole business. That doesn't need a lot of property, plant, and equipment, but other businesses do. So it tells a lot about the industry and the capital requirements of a business and how effectively are they generating sales off their fixed assets. And so to calculate it, we take the beginning plus the ending divided by 2 of fixed assets net book value, and then we divide sales by that. And for this business at McDonald's, it's 0.9. And if we take a look at the fixed asset turnover ratio of all these different businesses in the fast food industry, McDonald's has one of the lowest asset turnover ratios, and that's because they own more fixed assets compared to their sales compared to all these other companies. And if you've ever watched The Founder, right, the guy's like, we're not a fast food business, we're a real estate business. And McDonald's owns all the land, and a lot of times, I mean, they own all the land, and then they're receiving the royalties and franchise fees from their franchisees, but a lot of the revenue is in the hands of the franchisees. Jack in the Box, Chipotle, Yum Brands, there's 2 parts to the equation, right? Part of it is sales, part of it is average value of fixed assets. And Chipotle is likely purchasing less of the land, renting more, and they're also franchising less. And so McDonald's is franchising more and purchasing more of the land. So that's less sales and more land. And it really it just tells you something about the operations strategy of the business. And a company with a higher turnover ratio, that means they're using it more efficiently. They can scale the business a lot easier, because to generate to generate $4.50 in additional sales, they only need to purchase another dollar of fixed assets. McDonald's, they would have to purchase $1 in fixed assets to get another dollar in sales. That's kind of a good way to think about this. And so Chipotle can scale a lot more efficiently, carry a lot less debt, because capital costs money. Investors don't want to just pour money into a business if they aren't going to make more returns. Like there's an expectation there, and then the other way to raise capital is debt, and that costs interest and risk, really. And so yeah, that's and it's very different based on the industry. Companies like McDonald's, Union Pacific, ExxonMobil, really low asset turnover ratios because they need a lot of assets. They need a lot of fixed assets specifically for their business to run. Manpower Group does not. They could scale if they had more employees and they have more people looking for temporary employment jobs. They could scale to every city in the country in a year. That $1 more in fixed assets. Clearly, there's other headwinds there that would prevent them from scaling so quickly, but fixed assets are not going to be what prevents them from scaling their business. They could always find more retail rental space. And then companies in the middle ground would be like Macy's and Disney. There are a lot of fixed assets. Think Disney World. Disney World is, I think of Disney as an entertainment company and as a movie company, but Disney World itself provides 30 or 40% of the sales for Disney as a company. It's huge for them. And that is a lot of fixed assets. And Macy's has all the stores. So yeah, it depends on the industry. And then, digging into just what the notes can look like for a particular company. This is the Note 6 properties note for CSX Rail. They're the railroad in the northeastern portion of the United States, basically Chicago to New York, and then a lot of the South too. But they have the railroads have such a large amount of fixed assets that it's an important disclosure. And so they provide us a lot of information. And essentially their method is straight line for all their assets. And they're estimating that the rails are going to last 41 years, the ties 28 years, the locomotives 26 years, and the freight cars 32 years. And they have a different useful life for every single asset on their listing. And then they have their annual straight line percentage disclosed as well, just for our convenience, really. And then they also have land and construction in progress that's not currently being depreciated. Yeah. And then any questions on the disclosures and the presentation? Okay. And then now we're going to go over exchanging similar fixed assets or trading assets. So there's no cash involved, but we're basically trading in old for the new. And old equipment is often traded in for new equipment having similar use. In such cases, the seller allows the buyer an amount for an old equipment traded in, could be called like a trade-in allowance, and the remaining balance, either paid in cash or recorded as a liability on account, that's called the boot, and which is really from the tax code. That's why it's called boot, but I don't know, maybe think of it like booty, like pirate booty. I don't know. And the accounting for the exchange of similar assets depends on if it has commercial substance. It has commercial substance if future cash flows change as a result of the exchange. And if an exchange of similar assets has commercial substance, a gain or loss is recognized. If a and that really comes down to what is the actual value. If the exchange doesn't have commercial substance, if future cash flows will not change, then it doesn't matter. We're just going to keep the new asset is going to essentially just replace the old asset on the books, and there's no journal entry even required. And we're going to continue depreciating as normal because the business reality hasn't changed whatsoever. But assuming that there is a gain or loss on the exchange, we need to estimate the fair market value of the new equipment and the trade-in allowance of the old equipment, and then the cash paid. In this case, it's fairly easy to estimate because we know like they would give us a price and then a trade-in allowance, and then the cash plus the trade-in allowance is equal to the new price. And then the old equipment cost $4,000, had accumulated depreciation of $3,200. The book value was $800, and so the trade-in allowance minus the $800 would be the gain. So what we need to do is remove the old equipment, similar to selling it in the previous examples. So we debit accumulated depreciation equipment for $3,200. We credit the old equipment, and then we debit the new equipment's fair value. We have to record the new asset at fair value. That's our true historical cost. And then the cash that we paid, that's the boot, is the $3,900. And then the gain on exchange in equipment is the difference between our debits and credits, and also the difference between the book value and the trade-in value. And yeah, we just went over this. Assuming that only a trade-in allowance of $675 was allowed, in this case, the cash paid was $4,325. That changes our journal entry. So we have more cash in our credit, and And so to balance our debits and our credits, instead we have a loss of $125. And that's our book value initially was 800. 800 minus the trade-in allowance of 675. That's a $125 loss. And a loss on the exchange is a difference between the fair market value trade-in. So our loss was $125. So a printing press was acquired at fair market value of $275,000. It had commercial substance, and they traded in a similar printing press and paid cash for the difference between the trade-in and the new press. Assuming the trade-in allowance is $90,000, what is the amount of cash given? So we could assume that the amount of cash would be $275,000 minus the $90,000 trade-in value. That's then the amount of cash that we owe is the difference. And assuming the book value was $68,000, was there a gain or a loss? There would be a gain of $22,000 because that's the difference between the trade-in allowance and the net book value at the time. And the cash paid on the exchange would be $185,000. And then our journal entry, we would have to debit the accumulated depreciation for the old equipment, which would be 68,000 minus 175. That would be the accumulated depreciation amount there. So we debit the accumulated depreciation, credit 275,000 for the old asset. Oh, no, what? I don't know what the new, we don't know what the old asset's book value was, but we would have to, the net debit credit for the old asset would be 68,000. And then the debit for the new asset would be 275,000. That's what we recorded on our books as. And then the gain or loss we would have, so that would be a gain, so which would be a credit. But this is really just having us calculate the cash given on the exchange. That's the point of this, not the journal entry itself. Twin Pines Company, a water distiller, acquired a new bottling equipment machine with a list price of $220,000. They received a trade-in allowance of $45,000 and paid cash of $175,000. The old equipment was obtained, cost of $180,000. Accumulated depreciation at the end of the previous year was $120,000. And then annual depreciation was recorded of $12,000 each year. The exchange has commercial substance, and this is on July 1st, so we have to record the previous 6 months of depreciation. So we're going to have $6,000 in depreciation expense that we need to record first. And then we have to record the debit to accumulated depreciation equipment, which is the $120,000 plus the $6,000. And then a credit to the historical cost of the equipment, which was $180,000. We record the credit to the cash that was necessary. And then the new equipment is recorded at fair value of $220,000, which is the trade-in allowance of $45,000 plus the $175,000 in cash. And then we have to record a loss of $9,000 to balance our entry. And the best way to go about approaching these problems is like putting together pieces of a puzzle. We have all these facts in the problem, and it sounds like there's a process to doing it, but we know that we're going to have to record the initial depreciation first. So we record that first. And then we just start taking numbers from the problem we know are necessary to include. So we know that depreciation is going to be the previous year depreciation plus the new depreciation. We know that has to be a debit to remove.
This transaction,
Does the debits and credits not equal?
I might be just overthinking it, but
Um, so if we do 126 plus 220 plus 9. Okay. Good catch though. It's always good to, I mean, to question, right? But they they that's a huge part of the problem though, is saying, is it equal? Like on the homework, on the quizzes, don't leave anything on the table, so to speak. Make sure like all the problems are filled out with something. I see a lot of quizzes with incomplete answers where boxes aren't even attempted. So I highly recommend that you attempt every problem on the quiz and make sure that debits and credits are equal in all your journal entries. Um, but yeah, I mean, just going through the problem, the old equipment's historical cost was 180,000. So we know that that needs to be a credit. The cash needs to be a credit. And then once we have the um, the four, I guess, concrete ones that we know, the old equipment, the cash, the accumulated depreciation we calculated before, and we know the new fair value of the equipment because it gave it to us, then we plug gain or loss. And so it's really useful to not write the journal entry in order. Like the ones that you know are credits, put at the top. The ones that you know are debits, put at the top. The ones that you know are credits, put at the bottom. And then the gain or loss is kind of in the middle. And so if it was a debit or a credit, gain or loss, you could adjust. And that way you could, that's how I do it when I do these problems. Um, does anybody have any questions on trade-in? Otherwise, we're gonna go over some more examples just on the regular depreciation that I skipped to make sure that we could get to all of what we got to. Great. Yeah, I know these problems can be a lot, but going through slowly and just saying, okay, this is what I know. What do I need to do to complete the puzzle? That is the best approach to, I guess, tackling these problems because the concepts are simple. The details is where the mistakes happen. There's a lot of details in all these word problems, but the concepts are simple. I know every single one of you can calculate all the methods of depreciation. That's not the problem here. The problem, like the challenge is just keeping track of all the details. So when determining the cost of the land, this ski company has purchased attractive land into a ski resort. Think of Trollhagen, they had a recent expansion last year. It was awesome. And they basically, I mean, you can think of it as purchasing a new hill, and then there's a lot of stuff that has to happen to make it ready to go skiing. So, uh, should the tree cutting, land clearing, and grading costs of construction be debited to the land account? And should they be depreciated? And the answer is no, they should not be depreciated. Yes, they should be included in the land value because they're making it suitable for the intended use. However, in future years, this is all the cost to make it ready in the first place. First time ready, they purchase the land, they make it the mountain ready for it to go. Cutting down trees in the future, that's an expense. Like a repairs and maintenance expense would be an expense. That's just to maintain the land as it is intended to be maintained. And then building a ski lift would be construction in progress, and then buildings or equipment or land improvements or whatever they want to call it, and then depreciated over the useful life of the ski lift. And pouring the concrete for the ski lift, that would be a part of the ski lift, not a part of the land. But actually preparing the land to be ready would be debited to the land account initially when they start. Um, Each of the following estimates to useful life should be stated as a percentage. So we just divide 1 divided by the amount of years for every single one of these examples. For example, a 25, oh God, this is not easy on the eyes. But for example, a 50-year useful life is 2% per year, or a 40-year useful life is 2.5%. Think of like CSX, they're depreciating the actual physical metal rails of the railway at 42 years, and it was about 2.4% per year. And so that's simpler to calculate every single year, multiplying it by the percentage instead of taking the historical cost and multiplying it. There's more than one way to calculate depreciation, but getting the percentage, this is how we do it. And then getting for the double declining balance method, we have to compute the percentage and then multiply it by 2. And then for units of activity, we are going to estimate each of these 4 vehicles, how long is it going to last? And what's the depreciation during the current year? So we have historical cost, estimated residual value. So we have to take cost minus the residual value, divide by the total amount of miles, and then multiply by the amount of miles in the current year. And in this case, it's fairly simple to compute the amount of miles every year. But one trick to look out for is we need to make sure that our ending accumulated depreciation doesn't push us under our salvage value. Similar to double declining balance method, like what if the car lasts more than 200,000 miles, for example, number 3, then there'd be no more depreciation expense left anymore. We would just simply carry it at the estimated residual value on the books. There'd be no more depreciation expense because we fully depreciated the cost in previous years. And that's pretty common. Like office furniture gets depreciated over 7 years, but like I guarantee you that chair is more than 7 years old. And this lecture hall is super old, but probably still, like it's still on the books. These chairs are still on the books of Anoka Ramsey, but they are not being depreciated every year, right? So, and so we calculate that our total depreciation expense is 18,980, and so we debit depreciation expense, credit accumulated depreciation trucks. And under this method, we're using straight line and double declining balance method. And to depreciate a tractor over 10 years. And no residual value. So under the straight line method, we take 10% of the historical cost each year, which is $9,000 because it's 10% of 90,000. And in this double declining balance method, we take 20% of 90,000 in the first year to get 18,000. And then we have to multiply 20% by the net book value in all following years. And that would be 14,400 for the second year because we take 90,000 minus the 18,000 in the first year and multiply by 20%. Under partial year depreciation, in this example, we have a piece of equipment placed into service May 1st, useful life 10 years, and we're going to calculate with the straight line method and the double declining balance method. And for the straight line method, we take the depreciable base of 105,000 minus 12,000 and then divided by 10. That's our annual rate. And then we have to divide by 12 months to get the monthly rate and then multiply by 8. and then we get 6,200 in depreciation in the first year. And in the second year, we're only using our annual rate of 9,300 per year. And under the double declining balance method, it's a little bit more complicated, right? We take 20% of the total value of the total historical cost of 105,000, and then we take 8 out of 12 months off of that amount. And so that's 14,000 in the first year, despite it would have been 21,000 for the whole year, I think. So then in the second year, we start 20% times the net book value, so 105 minus 14,000. And then for revision of depreciation methods, if we depreciate this asset, we start with a $2.2 million cost. We have a straight line method, residual value of 85,000, and a useful life of 40 years. What does it look like at the end of 28 years of use? We take the straight line percentage of 2.5% times the depreciable base, and our accumulated depreciation is, the annual depreciation is 52,000 a year. The total depreciation over 28 years is 719,000, and then 28 years in, we find something wrong with the building, and it's only going to be used for 5 more years. So we have to depreciate the remaining depreciable base, which is the new salvage value, and we take the current net book value minus of 719,000 minus the new depreciable base divided by the new useful life of 5 years, and we get 131,000 in new depreciation expense every year. So that's it for this week's lecture. Thanks, everybody.